For most of my life, I thought gold was a poor investment. I said it in shareholder letters, I said it in interviews, I said it on stages in front of thousands of people. I was clear about it. Gold produces nothing. It just sits there. It does not build a factory, hire employees, develop a product, or serve a customer. It reflects light and attracts fear. And I believed for a very long time that fear was a weak foundation for any serious investment. Now, here is where this gets interesting. The people who know me will tell you I do not change my mind easily. I have held positions in businesses for 30, 40, 50 years. When I believe something, I believe it with real conviction. So when I tell you that my thinking on this particular subject has shifted, I want you to pay attention to why. Not to the conclusion, to the reason. Because the reason is not about gold. It never is. The reason is about something much more fundamental, something that most investors are not looking at closely enough right now, and something that, once you understand it, will change the way you look at every asset in your portfolio. The smartest, most patient, most quietly powerful money in the world has been moving into gold. Not talking about it, moving into it. And the gap between what they are saying and what they are actually doing is one of the most important signals I have seen in decades. Let me show you exactly what is happening, and more importantly, why it matters to you. I want to start with a number, not an abstract one, a real one. In the year 2000, the total United States national debt was roughly $5 trillion. By 2008, it had doubled to $10 trillion. By 2020, it had reached $27 trillion. Today, it sits above $36 trillion, and it is still climbing. Most people hear those numbers and nod. Then they go back to checking their portfolios. But here is the question they are not asking. What happens when a government owes more than it can realistically repay? There are only three options. It can default. That has catastrophic, immediate consequences, and no major government in the modern era has done it voluntarily. It can cut spending and raise taxes aggressively enough to close the gap. That is politically nearly impossible. Or it can let the purchasing power of its currency quietly, gradually decline. Option 3 does not require a vote. It does not require an announcement. It does not even require anyone to admit a decision was made. It just requires creating enough new money to keep things running. And the consequences land slowly, across years, in ways that most people do not notice until the damage is already done. Now, I am not predicting the end of the dollar. I am not predicting hyperinflation. I have watched too many smart people make dramatic predictions too early and lose credibility they never recovered. That is not what I am doing here. What I am saying is simpler than that and more verifiable. When the supply of money grows faster than the supply of things that money can buy, each dollar buys less. That is not a theory. That is arithmetic. And over the last 2 decades, the supply of dollars has grown at a pace with no peacetime precedent in American history. Your dollar today buys substantially less than it did 10 years ago, not because the economy failed, because the number of dollars in circulation grew faster than the economy did. That distinction matters enormously, and most people miss it entirely. Now, here is where it gets dangerous. Most retirement savings, most pension funds, most of what the average person has spent a working lifetime accumulating is denominated in that same currency, which means the risk is not just in the markets. It is in the unit of measurement itself. And that is the risk that something very specific and very old has historically protected against. I want to tell you about a conversation I had with my partner, Charlie Munger, not long before he passed. Charlie and I had been aligned on gold for decades. We both found the arguments for it unconvincing. Neither of us trusted assets that produce nothing. And we trusted American institutions, not blindly, but based on a long track record of watching the system handle crisis after crisis and come out the other side. But toward the end, Charlie said something to me that I have thought about many times since. He said the question was never whether the institutions were trustworthy. The question was whether the arithmetic they were operating inside left them any good choices. That distinction stopped me cold. because he was right. You can have the most talented, most ethical people running a central bank in the world. And if the mathematical situation they inherited gives them no good options, they will still produce outcomes that quietly erode the value of savings across an entire economy. Not because they want to, because the numbers leave no better path. When I started looking at the Federal Reserve not as a question of trust, but as a question of arithmetic, my conclusions began to change. I also started paying closer attention to something I had always known but had not fully examined in this context. Berkshire has always kept a large cash position, larger than most investors thought was rational. People asked about it for years. Why hold all that cash when you could be deploying it? The honest answer was always partly about waiting for the right opportunity. But there was a second reason underneath that one. Cash is stability. It is the ability to act when others cannot. I have always believed that. But what happens to that stability when the currency the cash is denominated in is itself being systematically diluted? That question changed the way I look at things. And it is the same question the most sophisticated investors on the planet have been quietly answering with their balance sheets for the last several years. Now, I want to name something that most people in the financial industry will not name for you, because naming it costs them money. The financial services industry is built on managing paper assets, stocks, bonds, cash equivalents, structured products. The fees these institutions earn are calculated as a percentage of what they manage. They earn those fees whether your portfolio goes up or down, and they earn them specifically on the asset classes their systems are built to handle. Gold held in physical form does not generate the same fee revenue. It does not generate trading commissions, currency conversion fees, or the dozen other revenue streams that a conventionally managed portfolio produces. The industry is not conspiring against you. It is simply following its incentives. But its incentives are not aligned with yours. That is the first layer. Here is the second. The major banks, the big brokerages, the mainstream financial press, they all operate from a shared framework, a set of assumptions about how markets work, how the Fed behaves, what inflation does, and what role gold plays. That framework was built in a different monetary era, and many of the people inside it are too invested in it to seriously examine whether it still applies. Intelligent people working inside a flawed framework can reach conclusions that are more dangerous than ignorance, because the conclusions arrive with the full credibility of sophisticated analysis behind them. And here is the part that almost nobody is talking about. The very institutions that manage the fiat currency system, the central banks themselves, have been among the largest buyers of gold on the planet for the last several years. The Bank of China, the Reserve Bank of India, the National Bank of Poland, the central banks of Turkey, Singapore, Qatar, and dozens of others. In 2022, central banks collectively purchased more gold than in any year since 1967. They came close to matching that record in 2023. The institutions whose credibility depends on confidence in paper money are quietly, methodically, in record quantities buying the one asset that exists completely outside the paper money system. I want you to sit with that for a moment. What do they know that the average investor has not been told? Let me give you the data, because this is where the conversation moves from theory to something you need to take seriously. Central banks have been net buyers of gold every single year since 2010. Not occasional buyers, consistent, increasing, deliberate buyers. And the list of countries doing it is not who you might expect. China has been steadily reducing its holdings of United States Treasury securities while growing its gold reserves. Russia did the same before sanctions changed its situation. But it is not just countries with geopolitical motivation. Poland added more gold to its reserves than almost any country in Europe. Singapore doubled its holdings. These are not rogue actors or conspiracy theorists. These are sophisticated, cautious, technically oriented sovereign wealth managers making cold analytical decisions about their long-term reserve composition. And they are all reaching the same conclusion, that a portfolio concentrated entirely in dollar-denominated assets carries a form of risk that their current environment no longer justifies. Now, here is what that actually means, and this is important. A reserve currency shift does not happen overnight. It does not happen with an announcement. It does not trigger a crisis on a Tuesday afternoon. It happens the way Hemingway described going bankrupt, gradually and then suddenly. The gradually part has been underway for years. The data is in the balance sheets. It is not hidden. It is just not being discussed by the people whose business model depends on you staying invested in the asset classes they manage. Most people will not see it until the suddenly part arrives. By then, the positioning that mattered will already have been done. I want to be honest about what gold is and what it is not in this picture. Gold is not a growth investment. If you are 35 years old with a long time horizon, the majority of your capital should still be in ownership of productive businesses. That principle has not changed. Businesses that earn money, grow, and compound over time are still the most reliable path to long-term wealth. I have believed that my entire life, and I still do. But gold is something else. Gold is insurance. It is a position that says not that the economy will fail, but that the unit of measurement for economic value is itself under pressure. And when that unit is under pressure, owning some quantity of the asset that has served as the reference point for monetary value across every major civilization in recorded history is not irrational. It is, if anything, the most historically grounded decision available. I need to stop here and make a distinction, because if I do not, everything I have said will be received in the wrong way. When most people hear that gold matters in this environment, they picture a specific type of investor, survivalist, panicked, stockpiling coins in a basement because they believe civilization is about to collapse. That is not who I am describing. The central banks buying gold at record levels are not afraid. They are precise. They are running careful calculations about currency exposure, portfolio composition, and historical asset behavior during periods of monetary stress. Fear is not their operating mode. Analysis is. And this is what smart money understands that most retail investors do not. The sophisticated buyer of gold is not selling their equities. They are not predicting a crash. They are not making a dramatic bet against the system. They are recognizing that a portfolio constructed entirely from assets denominated in a single currency carries a form of concentration risk, and they are reducing that concentration in a measured way. That is all this is, risk management, not panic, not prophecy. The difference between fear-based gold buying and analysis-based gold buying is everything. One is a reaction to noise. The other is a response to data. The central banks are responding to data. And now here is the question that matters for you personally. If the most analytically sophisticated institutions on the planet have looked at the same data I have been describing and concluded that their reserve portfolios needed more gold, what does that tell you about the conventional wisdom your financial advisor is working from? It tells you the framework is behind the data. And that is a problem worth taking seriously. I am going to give you 3 principles, not a price target, not a specific trade, not a prediction about where gold will be in 12 months. I have spent my career avoiding that kind of prediction, and I am not about to start now. What I can give you is a framework grounded in the same first principles that have guided every major decision I have made over 70 years in markets. Principle 1. Size the position to the risk, not to your conviction. This is the single most important thing I can tell you about how to approach gold. The central banks adding gold to their reserves are not putting 50% of their holdings into it. They are making deliberate, measured allocations. Poland did not abandon the euro. China did not stop holding treasuries. They reduced their concentration. They diversified toward an asset with different risk characteristics. That is the model. For most investors, thinking honestly about currency debasement risk, an allocation somewhere between 5 and 15% of investable assets is the range worth examining. The exact number depends on your circumstances, but the principle is clear. This is insurance, and insurance should be sized to the risk, not to the fear. Most people who buy gold buy too much when they are scared and none at all when they are calm. Both of those are wrong. The right time to buy insurance is before you need it and in the amount the risk actually justifies. Principle 2, own gold in its most direct form. There are many ways to get exposure to gold: mining stocks, ETFs, futures, certificates, structured products. Each of them has uses, but each of them also introduces a layer of counterparty risk or institutional dependency that partially defeats the purpose. The reason gold matters in this specific environment is precisely because it exists outside the paper financial system. It cannot be defaulted on. It does not depend on any institution remaining solvent. Its value does not require any financial infrastructure to keep functioning. If you own gold through a financial product that requires that same infrastructure to deliver its value, you have not hedged the risk. You have repackaged it inside a slightly different wrapper. Physical gold held in a form and location that does not depend on any single institution is the most direct expression of what gold actually is. For the specific risk you are hedging, proximity to the underlying asset matters. Principle 3, measure gold against purchasing power, not against the dollar. This is the subtlest of the three, and the one most investors get wrong. If you measure your gold position in dollar terms, the numbers can mislead you. When gold rises in dollars during a period of dollar weakness, that is not necessarily a gain in real wealth. It may simply be the currency declining and gold holding its ground. The correct question is not what your gold is worth in dollars today versus when you bought it. The correct question is what it can purchase in the real world today compared to then. That is the measure that matters. An ounce of gold bought a fine garment in ancient Rome. It buys a fine suit today. The dollar price of both changed beyond recognition. The underlying relationship held. That is the property you are acquiring when you buy gold. Not a bet on a number, a bet on the persistence of real value across monetary systems. And right now, that bet is more rationally priced than it has been in a very long time. Now I want to tell you the part that nobody selling gold will tell you. Gold is a frustrating asset to hold when the monetary environment is calm. There will be years, possibly long stretches of years, when your gold position does nothing while equity markets compound at rates that make your insurance position feel like a mistake. That is not a flaw in the logic. That is what insurance does. When you buy homeowners insurance and your house does not burn down, you do not conclude the insurance was foolish. You conclude you were fortunate. Gold is the same. If the monetary situation normalizes, if the debt is addressed with more discipline than history suggests is likely, your gold position will underperform a fully invested equity portfolio. That outcome would not mean you were wrong. It would mean the risk you hedged did not materialize on your timeline. The danger is not in owning gold when the risk does not appear. The danger is in not owning it when it does. I also want to say something about the gold market itself, because it attracts more than its share of promoters. The newsletter writers predicting $5,000 gold by Christmas. The coin dealers emphasizing crisis to move inventory. The social media accounts building audiences on panic. These are not your advisors. They are salespeople who discovered that fear is an effective commercial proposition. The analytical case for gold in this environment does not require believing in catastrophe. It requires nothing more than an honest look at money supply data, government debt trajectories, and central bank reserve behavior. The math makes the case on its own. You do not need to add drama to it. And one more thing. I do not know when the consequences of the current monetary situation will fully show up in asset prices. Nobody does. Anyone claiming a specific timeline is guessing, regardless of how confident they sound. What I know is that the structural conditions making gold relevant are not resolving on any timeline that is visible from here. The debt does not shrink. The money supply does not contract meaningfully. The shift in central bank reserve behavior does not reverse. These are slow-moving structural forces They play out over a decade or more, and they reward the patient, measured investor who sized a position correctly and then simply held it. That is the kind of investor I have always tried to be. There is a question I have come back to throughout my career whenever I needed to test whether a belief still held up. The question is simple. What would have to be true for this to be wrong? I find it is the most useful question in investing, not what has to go right for an idea to work, what has to go right for the idea to be wrong. Because if the conditions required to invalidate the thesis are themselves unlikely, the thesis deserves serious weight regardless of how long you have believed otherwise. So I apply that question now. What would have to be true for the case for gold in this environment to be wrong? The United States government would have to significantly reduce deficit spending and start bringing the debt down. The Federal Reserve would have to sustain real interest rates high enough to compensate savers, even at significant economic cost. Central banks around the world would have to reverse years of gold accumulation and return to holding primarily dollar-denominated reserves. And the historical relationship between money supply growth and long-term currency purchasing power would have to turn out to be different this time than it has been in every prior instance in monetary history. Those things could happen. I am not saying they cannot, but an honest, probability-weighted look at each of those conditions does not support confident predictions that they will. And when the conditions required to invalidate a thesis are each unlikely, the rational response is to update the thesis. Even if you held the opposite view for decades, even if you said it publicly, especially then. I spent my career inside a monetary system that rewarded confidence in productive businesses and paper assets. That confidence was well placed. The system worked because the conditions that made it work remained stable. I built my career and Berkshire's results on the foundation of that stability. But I have been watching those conditions change. Not dramatically, not overnight, directionally and persistently, across a span of years long enough that I no longer believe it is a temporary deviation from a stable baseline. I believe it is a structural shift. And structural shifts have structural implications for how a serious investor builds a portfolio. The investors who will look back on this period with clarity are not the ones who made the most aggressive bets or the most dramatic calls. They are the ones who read the data without the filter of institutional consensus, made measured adjustments, and held their positions with the patience that this kind of shift demands. The smart money is not panicking into gold. It is walking into gold, deliberately, quietly, at a pace that reflects a cold-eyed assessment of a risk that the mainstream financial conversation has been slow to fully acknowledge. I started my career in Omaha, reading financial reports before sunrise, looking for the thing the market had not yet priced correctly, looking for the gap between what something was actually worth and what the world said it was worth. That gap exists today, not in a stock, not in a sector, in the broader understanding of what is happening to the monetary foundation that every paper asset in the world sits on top of. The central banks have already told you what they think, not with words, with their balance sheets. The question is whether you are reading them.